Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is getting started with options. So today, I wanted to talk about options for that new trader who's just learning about this whole sort of intimidating world of options trading. Options have a bit of a reputation for being complicated, but the concept of just precisely what an option contract is doesn't have to be complicated. So today, it's story time. I want to tell you a story that I told to my own brother when he asked me how options work. My brother is actually a truck driver, has no experience in the world of options or finance or markets. And so we jumped in his pickup, went for a little drive, and I explained how options work. And I want to tell that same story to you. And then we're going to connect that to real life and actually go trade an example option. I think it should be a really good discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out in YouTube. I always like seeing all my familiar YouTube friends. Hello there, Sharon and John, Jay Richardson, Richard, Will, Mighty Quinn, Derek, Lawrence, Greg, Jack, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And as a matter of fact, I've explicitly designed this discussion with the new trader in mind. So great to have you here. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Tuesday webcast series. We kick things off promptly at noon Eastern. Love to have you in the live stream audience. And as a treat for our live stream audience members, my very good friend Connie Hill is going to be hanging out in the YouTube chat, addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody watching. If you have an account with X, you should be following your favorite Schwab presenters there. It's the best place to connect with your favorite presenters in between these live streams. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. When the camera's not on, I'm constantly checking several times each day. What are people saying on my posts on X? And I try to reply right back to you if you reply to one of my posts. But in any case, let's get into this discussion of getting started with options and explicitly going through that story that I told to my brother as we sat there in his pickup. But as we do, of course, options trading involves risk. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so let's set an agenda for today's discussion. I want to start it off with story time, telling the story that explained the world of options trading to my truck driving brother. Then we're going to take that story and apply it in real life using a stock. And then we're going to plan in place an example options trade before we're done. James says it's your first time, you're a newbie. Great to have you here. Hello to all the rest of you newbies. It's always appreciate having new people joining. But let's just put the camera on me for a minute, and I want to tell this story. So, yeah, I'm a money guy. I've been in the markets since the mid '90s. My brother is a truck driver. He's been a truck driver for decades. Has no experience with the markets, but he and I were going for a drive one day in his pickup. And he says, "Hey, Cameron, I've heard about these things called options. Can you explain how those work? I understand they're pretty complicated. Is that right? Kind of dangerous?" Well, both of those can be true. But I turned to my brother and said, "All right, well, let me put it this way. I want to tell you a story. Let's say that you've been paying attention to the real estate market in your area." And he said, "Oh, yeah, it's been hot." Okay. Well, imagine that you look down the lane there at your neighbor Paul's house. You think, "Ooh, Paul's got a nice house. Maybe I could get in on this real estate game, go and buy Paul's house." It looks like it's probably a $500,000 house. Let's just put that as the number for today's example. And you think maybe over the next year, if that house appreciates in value, maybe you can make some money. Well, you're thinking about that, weighing the pros and cons of putting down $500,000 on a house, and you have a brilliant idea. Ooh, I have a brilliant, different way to approach this transaction with Paul. So I tell my brother, just imagine you go to your sock drawer, you pull out $10,000, just like everybody has in their sock drawer, a big fat roll of bills, and you walk on down the lane, you pound on Paul's door, and he answers the door, and you say, hey, Paul, I have $10,000 and I want to give it to you. You now have Paul's attention. Paul says, what are you up to? Well, I think I might want to buy your house, but I haven't made up my mind just yet. So what I'm proposing here with my $10,000, I'd like to give you this money. And in exchange, I want your promise, a contractual promise. We'll just write up a little promissory note here that I have the exclusive right for, let's say, the next year to buy your house, and I'll pay you $500,000 for it if I decide to buy it. But I want the option to buy your house. I just haven't decided if I want to buy it just yet. And so Paul says, so, okay, wait a second. You're going to give me $10,000. Right. And if you decide to buy my house sometime in the next year, you're going to give me another $500,000. So I'm actually get $510,000, right? Yes, that's actually correct. The $10,000 is not a down payment. It's an enticement, basically, to get into a contract with me so that I have the exclusive right to buy your house. I have the option to buy your house. And Paul says, I think we have a deal. So Paul accepts the payment, and we now have a contract. And you say, now, wait a second. One other thing I want you to be aware of, Paul, before we sign this document is that if I decide anytime over the next year that I'm done with this, maybe I'm not going to buy your house, I want the right to transfer my right to buy your house to somebody else. I want to be able to sell this contract to somebody else for whatever remaining time it has on contract. Paul's like, I don't care what you do. Give me the $10,000. That, in a nutshell, is a description of what we call a call option. So I tell my brother, now let's imagine what might happen over the course of the next year. Let's say that we get 6 months down the line, and you thought, ooh, maybe this house that's $500,000, maybe it'll grow in value to $600,000 within the year. And let's say 6 months down the line, the house is worth actually $600,000 already. It's been a really strong real estate market. What might you do then? And so my brother says, well, so I go buy his house, right? Well, you could do that because the contract says you can. Or you have this transferable contract that we can go now sell to someone else. How much is that contract worth at this moment? So my brother says, well, if I get a $600,000 house for $500,000, that's $100,000 value in that contract, right? Exactly. So you might go over to, let's say, your neighbor Sharon's house and say, hey, Sharon, I have a contract here that says that I can buy Paul's house. And Sharon says, oh, well, that's a nice house. Yeah, my contract says that I can buy Paul's house for $500,000. And Sharon says, you kidding? That's a $600,000 house if it's worth a penny. And so let's say you reach an agreement to sell your contract to Sharon for $100,000, plus there's still 6 months left on this deal. Sharon doesn't even have to buy the house just yet. That house could continue to appreciate for the next 6 months. And now Sharon's got an even sweeter deal. So let's say Sharon agrees you to pay $100,000 plus a few $1,000s more in compensation for the remaining time value on that contract. And Grant's saying, now, wait a second. So all along, I only had $10,000 at risk, right? I invested $10,000. I didn't have the obligation to buy his house. Is that correct? That's right. You had the right to buy the house at any time for the next year, but not the obligation. Well, that's amazing. Now, this is just a hypothetical scenario. Not every house is going to appreciate $100,000 in 6 months, not under every set of market circumstances. So we need to explore what else could have happened. So I asked my brother, so let's talk about what else could happen. Well, what if the house didn't go up in value? What if over the first 6 months, the house goes down in value? It's worth $450,000 now. And he's thinking, yikes, this $10,000 investment that I made is not looking great. But I'm glad I didn't buy the house, because had I bought the house for $500,000, and it's down now to 450, I'm sitting on a $50,000 unrealized loss. So I'm feeling, not great about my $10,000 I might be squandering here, but maybe it's a better scenario than ownership of that asset. True. All right, now what if you tried to go sell that contract to Sharon now? Hey, guess what, Sharon? I have the right to pay $500,000 for a $450,000 house. Sharon's probably not going to be terribly interested. Maybe you discount that $10,000 that you paid for the contract. How about I sell you this contract for $1,000? Maybe the house value recovers in the remaining 6 months, but we're taking a hit one way or the other on this contract. But this back and forth that I had with my brother, he's asking really good questions at this point and really understanding this contract that he's entering into. And this, in a nutshell, is a pretty good description of this world that we're discussing, known as options trading. So in the world of options, we would refer to this as a call option, because if we have, let's put ourselves in my brother's shoes, we own a contract where we have the right to buy an asset for a fixed price, that house. And let's say at some point within that 1 year time frame, we decide, okay, I'm going to buy the house. In the old days, maybe we gave a phone call to the owner of the house and said, hey, I'm calling, exercising my right to buy your house, whatever. So that's kind of what I think of when I consider the reasoning for the naming of the contract as a call. But all of this is still hypothetical. Cameron, we're talking about houses. I thought this was that we're talking about stock options. Well, yeah. Yep. Let's now shift gears, if you'll forgive an additional pun, and turn this into the stock investing world. A stock option contract is just that. It's a basic contract. And if we look at the elements of what we just discussed in this scenario with my brother, it transfers very nicely into the stock options trading world. It's a contract between a buyer, the one who's paying for the option to buy, and the seller, the one who's receiving the payment and providing a promise to deliver an asset at a fixed price. But it's a contract between a buyer and a seller, wherein there is a premium paid from the buyer to the seller to set up a contract to possibly exchange an asset. In this case, instead of a house, it would be 100 shares of stock typically, for a fixed price for a fixed period of time. The contract expires eventually. And these contracts are transferable. There's an active secondary market for these options. So there we go. Dragon Rider, you like that example? I hope it made sense to everybody, but let's now go connect it to real life. We've been talking about hypotheticals up until now. Let's bring up a stock and set up a scenario where maybe a trader, instead of being intrigued by the housing market, maybe they're intrigued by a stock's potential, and they want to trade stock options on that. So here we're going to look at Apple. And if you'll notice what's been going on with Apple recently, it's been popping upward in short bursts that have been relatively consistent over the last several months. I'm going to zoom in on just this most recent time frame, and you'll see just over the last maybe week and a half, Apple has run up from $226 up to about $241, about a $15 run up. Now, what I did is I drew a line here to represent that $15 increase in price, and I noted there was a $15 move right here before a gap or after a gap. There was a $15 move preceding that gap, and the last time Apple got a nice tailwind, it also ran up about $15. So let's put ourselves in the shoes of a stock trader who maybe notices the stock has run up, now it's pulled back, and maybe their conviction is that it's likely to pop again. Now, Dragon Rider says Apple has a workshop this evening. Yeah, so Apple's annual event is today. What are they calling it? The awe-dropping event? Yeah. Well, it's possible. Now, I'm not saying what's going to happen after this event. It's possible that the shareholders may not be impressed by what Apple has to say and the shares go down, or they may be very impressed and the shares go dramatically upward. Interesting. Well, let's just say that our trader here just thinks maybe this event could spur just a proportionate move like what we've seen before. So zooming back out again, if today's low is around 235, a $15 increase from that low might take us up around 250. So let's say they think, oh, it's possible the stock might go up to $250 in pretty short order. So what could that trader do on that assumption? Well, maybe they just buy the shares. So if they buy the stocks right now, they're paying a little bit more than 235, actually paying around 236. That'd be a $23,600 investment. But if the stock goes up, hey, they're looking at maybe $14 of potential return. Now, if the stock doesn't go up and it goes down, how much risk is there? Well, the worst case scenario is the stock could fall to zero and they could lose $236 per share. But instead of buying the stock, maybe they decide to get into one of these contracts that my brother and I were talking about. So let's go to the trade tab, and I want to introduce you to the list of available contracts, right? So in my hypothetical scenario, I discussed getting into a contract where I kind of pulled a time frame from thin air. I said a year. But in actuality, for options traders, they can get into contracts that stretch anywhere from just a few days. That's this number in parentheses, as we're looking at this area of the trade tab called the option chain. This is the chain of available options contracts. And these are, to me, I think of it as like a bulletin board. It's an advertising board for contracts that might be entered into by buyers and sellers. But we could get into contracts that run only for a few days, all the way out to contracts that run for multiple years, 829 days. These would be running through and expiring on the 17th of December of 2027, or 829 days. And they represent the potential exchange of 100 shares. That's what the 100 means. Or we could get into a contract for just 3 days, or pretty much anywhere in between. All right. So going back to our example here, let's say that our trader thinks that the stock might run up for a week or two, maybe traveling upward as much as $15 in a short period of time. Well, if they buy a contract, if they get into a contract that runs out in 3 days, maybe that's not enough time. If they buy a contract that's good for 829 days, that's providing plenty of time. But guess what? It's going to be expensive to entice. It's kind of a strong word, but it's going to be a big premium that we're going to have to pay to somebody. This trader might have to pay to somebody to lock in a purchase price for 829 days on Apple. So where is it enough but not too much? For some traders, they might find the sweet spot for the time frame of the contract to be about twice the number of days that they think they need to get this trade done. So if we're thinking maybe a couple of weeks, possibly our trader looks out here maybe at about a month. So I'm going to go to the 17th of October contracts. That's the 17th of October, 2025. They run for 38 days, and they represent the potential exchange of 100 shares of Apple. And now the next thing I'm going to look at is this column here that says strike. And this is the price at which we might strike a deal with another trader to maybe buy some shares of Apple from them. So we could strike a deal to maybe buy shares for $125. We could strike a deal to buy some shares for maybe $190. Or with those shares trading around $235, what if we look at $235? And if I look over here to the bid and the ask price, this is basically a representation of the current market price of these sorts of contracts. It looks like it's right around $8. So that's $8 per share. So if you think of my example with my brother, he was paying $10,000 for the right to buy a house for a fixed price of $500,000. In this case, we'd be paying around $800. That's $8 per share for the right to buy 100 shares. So that's $800 for $235 at any time through the 17th of October, 2025 for the next 38 days. So if it's helpful, let's come over here to the scratch pad and just write it out. So we're thinking of buying. Let me make this bold. We're going to buy the 17th of October $235 call for $8 per share. Or in other words, $800. So this is what I want to focus on at this point in the discussion. There's $800 being committed to this trade. We really want to understand exactly what we're getting into it. So to reverse the contract here, we're spending $800 for the exclusive right to buy 100 shares of Apple from someone else for $235 per share at any time, not on the 17th of October, but at any time between now and the 17th of October. That's a powerful thing to understand because it's quite possible the stock could go rocketing up and maybe the trader decides to buy those shares fairly early. Or maybe they decide to sell their contract to someone else because the contract has appreciated in value. All right, let's see. All right, so Josh is asking Connie a question, so I'll let you have that discussion there, Josh. Let's see if I'm missing anything. I don't think so. I'm not seeing any questions that I haven't addressed yet. But if we're laying out this $800, the trader really needs to understand what could happen from day one. So what I'm going to do here is I'm going to go ahead and place this trade because I think that really puts an exclamation point on the seriousness of what this trader is doing. Now, this is a simulated trading environment. There's actually not any real skin in the game. We can't get too excited about any profits that might subsequently appear on this trade. We can't get too intimidated by any losses because it's just a simulated trade. It's one of the great functions of the Thinkorswim trading platform. But I'm going to go to the 235 strike. Ooh, and it looks like the price just went down a little bit. Okay, maybe I'm going to be able to get this for a little bit less. I'll adjust this if we do. But to place my order, I'm going to go to the ask price. When trading options or stocks, typically when we're buying something, we pay at or near the ask price. Typically when we're selling, we sell at or near the bid price. It's kind of like if I were talking with someone and I were saying, hey, I want to buy an option from you. How much are you asking for a contract at the $235 strike? And they'll say, well, I'm asking $785. Okay, pay the ask price. If I'm selling the contract, hey, everybody, how much will you bid for this contract I'm selling? And we sell to the highest bidder, basically. That's the way I think about that terminology. But let's go ahead and click on this ask price to create a buy order. And I'm going to change this to just one contract. So if it's one contract, that means we're buying the right to have exclusive access to 100 shares of Apple for $235 per share. It's a call contract, trading somewhere $785, $790. Let's say we're willing to pay up to $790. Let's set that as our limit. And I'm going to click confirm and send. So buying one Apple 17th of October 235 call with a limit, that means the maximum we're willing to pay is $790. That would be a cost of $790. We could lose that. Plus, there's a 65-cent commission being paid. Let's send this off and see if we can get a quick fill here. Let me go to the working orders. We're offering to pay $790. The current market value is $785. I think this stands a pretty good chance to fill at that price. Oh, looks like we filled it. Actually, $780. Okay. So here's what just happened. Instead of paying $8 per share, we paid $780. That was $780. And now let's go back to our chart and talk about what might go on from here. So is everybody fairly comfortable with the analogy and now how we're connecting this to real life? We've just entered into a contract between a buyer, that's us, and a seller, someone else out there in the options trading universe, who now has the obligation to sell us shares for $235 per share. We have the right to buy those shares. In the old days, maybe give a call and say, I'm exercising my right to buy the shares at $235. Now, this right runs out on the 17th of October, so we have until then to decide what we're going to do. Maybe we wind up buying the shares, or maybe, and this is most commonly the case, we're just looking for this contract to hopefully increase in value. You've already seen how it can decrease. Let's see if it now can increase, and maybe we can then sell it at a higher price. So let's talk through what may happen from here. Let's see. We have a question there. Oh, that's back to Josh's question to Connie. Okay. In any case, let's say that maybe the stock does go rocketing up. Okay. And let's say that maybe by, let's push it out a little bit. How about by the 20th of September? So that's solidly before our expiration. This thing expires on the 17th of October. But let's say that right now is this September 9th. Let's say that maybe there's a very positive reaction to this big event that's being conducted by Apple today, or whatever other news contributes to the stock rocketing up to 250. Well, hey, if the stock's up there at 250 and we have the right to buy the shares for 235, how much value does that contract have at that point? We would call this the intrinsic value of the contract. We're getting a $15 discount on that future hypothetical value of the stock. There'd be a $15 intrinsic value. And if we went to sell the contract, that would be its minimum market value. But the market value would actually very likely be above that. Why is that? Well, as of September 20th, there would still be about 4 weeks left on this contract that we just bought. And if the stock just went up $15 in the first couple of weeks, wouldn't it go up even further in the remaining 4 weeks? So there is a remaining what we call a time value, also known as the extrinsic value of the contract, that adds additional value to it. So we'd be looking at a contract, we paid $7.80 for it, and then it's worth at least $15 plus a bit more for that time value. We could actually, okay, Robert says, how do you push the chart out into September? Good question, Robert. I did that right down here. See the little double-headed arrows? That's kind of like the width of the chart. It's called the expansion area. So if I change the expansion settings, I can click on that. Let's just change those expansion settings. I have this extra white space. It's kind of cheating out here, right? Change that. By default, it's going to be a 0. If there's a 0 in here, there's no extra space. So I just put in 10 and applied that, and we get that white space. Okay. But I'm going to go do a quick calculation. I want to show you a tool, a little calculator that can show us how much these contracts will be worth. It's actually very accurate calculator as long as our assumptions are correct. If we go back to the trade tab, I'm going to add a column here. Right now we're seeing 3 columns, delta, theta, vega. I'll leave those for a discussion at another time. But there's a calculator here. Let's go to our columns, and I'm going to customize this set of columns. And I'm going to add something called Theo price. So let's add that. Actually, just to make it a little, no, I'll leave it right there. Theo price, we'll just leave it right there. Click OK. But that just adds this column it's abbreviated. You can't see the whole name, but it says Theo price. But this gives us this calculator right here, which allows us to put in some assumptions about the trade. And my assumptions here were, what if the stock went up, let's put in a plus $15 by the 20th of September? If that happens to fall on a weekend, that's okay. We can still do it that way. As I put in those parameters, this column is now showing us the expected, oops, let's minimize that. I don't need that. Matter of fact, let me pop it back up here and delete this unintended order. Anyway, if we look at our strike and we look over at this column that says theoretical price, this is literally telling us, well, Cameron, according to the theory that you've presented, which is the stock going up $15 by the 20th of September, this contract would then be worth $20.47. And that's an extremely accurate estimate because this calculator uses the same algorithm that that current options are the prices of current options are generated from. Now, obviously, it may not go up $15 by the 20th of September, but if it does, that's pretty accurate. Now, there's one other parameter that we could have changed with, we could have messed with. I didn't do anything with it, but a stock's volatility or expectations about a stock's volatility can also have an impact. Let's just actually put that to 0. There we go. That's going to impact things. You'll see the value of our projected value of our option has changed. The initial assumption here was the volatility changed by 15%. Let's just say there's no change in volatility expectations. The only change is price going up 15 bucks by September 20th. Nifty little calculator there. This thing that we paid $7.80 for would then be worth about $18. CS says you love the Theo price. It's kind of a cheat code. In a way, yeah, it's nice. It's literally like a little calculator. We can put in theoretical assumptions, and it tells us quite accurately how that would impact the value of our option. But we also have to be aware that's nice if the stock goes up $15. What if it's going the wrong direction? I want to illustrate this because I was under the misunderstanding. I had the wrong impression when I first started learning about options, was that, oh, okay, so if I buy an option for the 17th of October, I have to sit there and just watch what happens. And if the trade starts going south, I'm kind of stuck. No, we're not stuck. As long as the trader is trading good liquid options, they have the choice to sell at the back end of the trade, whether the trade is going well or whether it's going poorly. Now, liquidity is an issue, and I'm not saying that it's just like that to get in or out of these contracts, but we're not stuck, basically. Let's say that our stock, instead of going up as we anticipated, maybe instead it's fallen down. Let's say that it's gone from 235, gone down $6 or $7. Maybe it's down at 229. Okay, so it's gone down this way. Matter of fact, it's already above here. So let me just remove this drawing. Oh, I'm drawing from the wrong spot. That's, I was like, why am I? Here it is. Let's draw from the correct place. Let's say it's gone down to 229. Okay, so not going up, but going down. Not good. Because we have the right to buy shares for 235, and who cares, because the shares are becoming less and less valuable. We might think, oh, this is not worth anything. I now have the right to overpay for shares, so surely my contract is worth zero, right? Yarek says, hey, is this the first video of the Getting Started course? Yes, Yarek, thank you. I'm actually going to make a suggestion for those that are new here. They may want to go check out that series of videos that I put together, all right? But in any case, let's see what happens. If instead of the stock going up over the next couple of weeks to 350, what if it fell down to 229? To round that off, that's about $7 from where it is right now. Let's go to our trade tab, and let's say we go minus $7. Uh-oh, what do you think is going to happen to this contract? Yep, we paid $7.80 for it. It's now worth less than half that. Risk is real. And as a matter of fact, if you put this in percentage terms, it was fun to talk about doubling our investment, which is what the initial scenario sort of laid out. Now we're talking about cutting that investment in half. So if a trader can't handle the volatility of seeing an investment maybe double or maybe lose 50%, buying options may not be for them. This is a great illustration of the kind of leverage that's possible with these call options. Because we're only talking about, are we talking about enormous stock moves on Apple? If it goes up 15 bucks, it's a $235 stock. That's, what is that, 6%? So a 6% move on Apple has produced an over 100% return on the call option. Now, if we reverse that, we're falling $7. That's about a 3% drop. So a 3% drop has created more than, let's say, a 55, 60% loss. Yeah, that is the reality of this world of options trading. So for some people, that's highly attractive, because if they think, hey, I'm really good with my timing and I want to leverage that up, this delivers that potential. On the other hand, if the trader is not confident, if they are concerned about volatility, about the risk associated with volatility, this may not be attractive to them at all. And in these webcasts, my purpose is never to convince someone this is the way to go. Nope, I want to weigh the pros and the cons, how the thing works, and then leave it up to the individual trader to explore whether it's ever going to play a role in their portfolio. In any case, we have to be aware that the stock can go down in this contract can go down in value. Now, a final thing that I want to mention here is that we can then put those assumptions. Maybe we double, maybe we lose 50, maybe we lose half. We can actually put it in order to take profits if we double or some other amount. We can put in an order to cut losses if the contract falls by half or some other amount. So let's do that. Let's come to the trade that we just placed. Here's our Apple call right down here. This is on our monitor tab. And I'm going to right click on that and let's create closing orders, right? So initially it'll say in the menu, create a closing order to sell the 100. Is this that's our Apple contract. Let me close up this left column for just a moment. We're not actually looking to sell this call right now because we just paid $7.80 for it. Maybe we could take a 10-cent profit at the moment. No, instead, we were looking to sell if we were able to double it or maybe a little bit more. What was that projected price by the 20th? I think it was $17.70. Or maybe the trader, let's just do this. If we paid $7.80 for it, what is double $7.80? Isn't that $15.60? I just did that math in my head. Call me out if I got it wrong. I hope I didn't. Anyway, let's put that in as a limit. We're going to make that a good till canceled order. So this is an order to take our profits if the stock's going the right direction. But what if we're going the wrong direction? Instead of just putting in a single sell order, let's put in an OCO. One order cancels the other order. We're going to put in two orders. And now I'm just going to right click on that first one and create a duplicate order. First one is to take profits. The other one is to stop the bleeding if we're seeing losses. And if we got in at $7.80, let's say the trader wants to stop the bleeding at half that. What's half of $7.80? $3.90. To make that a good till canceled order. And so what we've done here is just made an effort to define the upside and the downside potential of this trade. Is the 1560 within the range? If we get that move that the trader was anticipating, it was projecting maybe up to 1770. Well, maybe we're just trying not to be greedy. Let's dial that down. But a move of less than $15 in our time frame might produce that profit. On the other hand, if we're falling, we've drawn a line in the sand to get out at $3.90. Now, this stop, that $3.90, just like other stops, it's not a guarantee that we'll sell at exactly that price. The 1560, it either fills at or above 1560 or it doesn't fill. The 390, it might sell at 390. It might sell lower than that if the stock is falling hard. So this one's not a guaranteed fill here. But let's click confirm and send. And we're going to sell at 1560. That's our limit. We're going to sell at 390. That's our stop. Regarding that stop, due to potentially wide markets or liquidity risks at the time of activation, if this stop is activated, this order may be manually substituted with a limit order upon activation and worked until filled. But just be aware, 390, if the stock is falling hard, it may actually fill for less than that. Now, there are commissions to get into this trade, but also to get out of the trade. And let's send that order off. Okay. So from here, we'll see how it goes. But we've kind of gone from start to finish. We haven't covered every potential trade scenario. There's still plenty to learn about options. But I just intended this discussion to be sort of the starting point for someone who doesn't know a lot about options. You were able to put yourself in the seat of my brother. Truck driver, knew nothing about options. Hey, Cameron, explain to me how options work. Well, this is kind of how they work. So we went through the hypothetical scenario, but then connected that to real life using some real-time example. All right. Now, there's a lot more to learn about options trading. So to go back to, who was it? I like to give credit where credit is due. Yarrick said, isn't this just lesson one? Here's what Yarrick was talking about. First thing I want to suggest is if you haven't subscribed to our Trader Talks channel, do that now. You can go down in the lower right-hand corner, click on the subscribe button. You can just go down below the video stream, click on the subscribe button. But our Trader Talks channel on YouTube, and the full name is Trader Talks Schwab Coaching Webcasts. This is where we house our previous webcasts. And this webcast is just the latest in a whole series called Getting Started with Options. And you can find the previous webcast right here under the playlists. So I'm going to go to playlists, and I'm going to scroll down, right on down toward the bottom. We have a lot of different webcast series. So this one is Getting Started with Options, and you can see its full playlist right there. And a few months ago, it was actually about 8 months ago, I put together, this is what Yarrick is referencing, I put together a series of 8 lessons that were very structured to take a brand new would-be options trader from just learning the basics of options and really try to move them along their learning curve to really understanding how options work, and even get into what we call multi-leg option strategies like vertical spreads. But what you'll just need to do here is in this playlist, just scroll down to 8 months ago. You'll see that each one of these says this one's 5 months ago, this one's 6 months ago. Go down to 8 months ago, and right there, where it transitions from Barb, who used to do this webcast series, to me, you'll see there's lesson 1 of 10. And if you were to watch that lesson, it would sound a whole lot like this discussion that we've had. So you might not even have to watch lesson 1. You can just move on to lesson 2 and lesson 3 and lesson 4. There are 10. All right. But there we go. That's what Yarrick is referencing. I think that's great for someone who's new to options trading. I try to take everybody all the way. We don't talk about every option strategy under the sun, but I think that really helps accelerate the learning in this field of trading. All right, everybody. I'm going to let you go at this point, but I do have another couple of suggestions for you. After you've subscribed to the channel, make sure that you're following Connie and me on X. If you have an account with X, you should be following us there. It's the best place to connect with me in between these live streams. When the camera's not on, I'm out there on X. I'm replying to comments. I can see there are just a couple more here. I get a little notice every time somebody leaves a comment, so I go in and reply to those. Hey, Irma, my pleasure. Definitely. I will be back again next week. We're not going to be just moving on to lesson 2 next week. I'll pick a different topic. So this is not intended to like restart that series of lessons, but we will be exploring some other arena in this Getting Started with Options series. Bruce says, are we on Reddit? Nope, just on YouTube and on X, right? But everybody, the final thing I wanted to say is thanks for all the thumbs up. I definitely appreciate that. Clicking that like button sounds like applause to your presenter, but it also is an additional benefit to the presenter. It gives us a boost in the YouTube algorithm. It helps our videos reach more people. So always have the habit of clicking that like button. It looks like 58 have already clicked the thumbs up out of 150 something. That's fantastic. Thank you for doing that. Go have a great day, everybody. Enjoy the rest of our webcasts for the rest of the day. I will look for you in a future one of my webcasts. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.